You're 26 years old, working the night shift at a third-tier quantitative trading desk in Lower Manhattan, when the email arrives. It's 3:17 a.m. on a Tuesday. The subject line reads, "Immediate transfer, executive discretion." You've been at the firm for 18 months, mostly running backtest simulations on momentum strategies that never go live. The email says you're being moved to a department you've never heard of. Floor 41, report at 9 a.m. You almost deleted as spam. Your badge doesn't even access the 41st floor. But at 8:55 a.m., standing in front of the elevator bank with your coffee, you swipe your badge anyway. The reader blinks green. The elevator rises past floors you didn't know existed. When the doors open, there's no reception desk. Just a hallway with frosted glass and a single door at the end. A woman in her 50s opens it before you knock. "You're the one from the overnight desk," she says. Not a question. "Come in." The room is smaller than you expected. 6 monitors. 2 other traders, both older than you, neither looking up. The woman's name is Victoria. She doesn't offer her last name. She sits you down at a terminal and pulls up a chart you recognize immediately. The S&P 500 live feed. Every tick. "We don't trade momentum here," Victoria says. "We trade mass psychology. Specifically, we identify points where markets are about to break, and we make sure they break cleanly." You ask what that means. "It means when a crash is coming, we accelerate it. Controlled demolition. Better a fast collapse than a slow bleed that destroys pension funds and drags out for months." She taps a key. A new window opens. Algorithmic models you've never seen before, tracking not just price but sentiment indices, leverage ratios across broker networks, margin call cascades waiting to happen. You're here because you noticed the Fed's liquidity problem 6 weeks before anyone else did. Your report got buried, but we read it. You wrote that report at 4 a.m. on a hunch. You never thought anyone saw it. Victoria leans back. "Today's a test. European markets open in 90 minutes. There's a French bank that's overextended on sovereign debt Italian bonds. Specifically, they're about to get a margin call they can't meet. When they start selling, it'll cascade. We're going to give it a push. Your job is to calculate the optimal entry point for our short positions, so the fall is steep enough to trigger automatic breakers, but not so violent it causes a liquidity freeze." She slides a folder across the desk. Inside are position limits, counterparty exposure lists, and a number at the bottom, $840 million in deployable capital. "You have 40 minutes, she says. Your hands are shaking as you pull up the models. You've never traded with real money before, let alone nearly $1 billion. The French bank's exposure is worse than the overnight reports indicate. If they start unwinding positions, 3 other banks will follow within the hour. You run the scenarios. If you short the Euro stocks 52 minutes before their margin call hits, the selling pressure will compound. The market will drop 4% in 18 minutes. Circuit breakers will halt trading, panic contained. If you wait too long, the decline will be shallow, erratic. Retail investors will think it's a dip to buy. They'll get slaughtered when the real collapse comes 6 hours later. You input the trade parameters. Victoria watches over your shoulder. You hit execute at 9:47 a.m. CET. 18 minutes later, trading halts across European exchanges. The S&P futures drop 2% in sympathy. By lunch, your models show the panic burned out. The French bank's positions are unwound, no contagion. The market stabilizes by end of day down 3.5%. Painful, but surgical. Victoria doesn't congratulate you. She just nods. You're on the rotation now. Same time tomorrow. That's how you learn what Floor 41 really does. Over the next 3 months, you execute 7 more interventions. A Chinese property developer about to default. A leveraged hedge fund using synthetic ETFs to amplify returns that's about to implode. A cluster of regional banks holding bad commercial real estate loans. Each time you identify the fracture point, calculate the optimal moment to apply pressure and execute. The crashes are sharp, brutal, and over quickly. You tell yourself this is damage control. You're preventing worse outcomes. But you start noticing patterns. The positions Floor 41 takes aren't just reactive. Sometimes Victoria gives you a target 3 days before any public catalyst appears. She'll say, "Model a scenario where this sector loses 12% by Friday," and you'll build the trade structure, and by Thursday afternoon, some news breaks, a regulatory announcement, an earnings miss, a credit downgrade, and the sector falls exactly as modeled. You ask her once how she knows these things in advance. We don't know, she says. We create the conditions. The news is real. The catalysts are real. We just make sure the market interprets them the right way. You're not sure what that means until the Taiwan situation. It's late September. Tensions between Beijing and Taipei have been elevated for months, but nothing actionable. You're running stress tests on semiconductor supply chains when Victoria tells you to model a worst-case scenario, a naval blockade of Taiwan within 72 hours, and the market's response if chip exports stop. You build this scenario, a 16% drop in the Nasdaq, 28% in the Philadelphia Semiconductor Index, trillions in market cap erased. She tells you to prep the short positions, but not execute yet. 2 days later, a Taiwanese fishing vessel is detained by the Chinese Coast Guard. It's a minor incident. It happens every few months. But within an hour, 3 major financial news networks run simultaneous stories about escalation risks. The semiconductor stocks start falling. Not crashing, just falling, steady and ominous. You watch the flow of sell orders. They're not panicked retail. They're institutional. Coordinated. Victoria tells you to execute the shorts. By market close, the semi-index is down 19%. The next morning, the U.S. announces an emergency diplomatic envoy to Beijing. The fishing vessel is released. Tensions ease. The market recovers 8% over the following week. Floor 41 closes the short positions. The profit is $1.4 billion. You don't sleep well for 3 nights after that. You keep thinking about the fishing vessel, the timing, the news coverage, the institutional selling that started before any rational actor should have been worried. You ask one of the other traders, a man named Elliot who's been on floor 41 for 6 years, if the firm has relationships with journalists. We don't need relationships, Elliot says. We just need to understand how information moves. You give the right analyst the right data point, they write the story they were always going to write. We don't fabricate. We curate. And the fishing vessel? Elliot looks at you like you're naive. You think that was us? That was random. We just knew it didn't matter. What mattered was how the market would interpret it if we shaped the narrative correctly. The news is always there. We just decide which news gets amplified. That's when you realize floor 41 isn't responding to crashes, it's engineering them. But the rationalization comes easier than you expect. The crashes are going to happen any way you tell yourself. Markets are fragile, over-leveraged, built on sentiment and momentum. All you're doing is controlling the timing and severity. Better a managed collapse than chaos. You've seen the models of what happens when crashes are uncontrolled, liquidity vanishes. Clearinghouses fail, the entire financial system seizes. What you're doing prevents that. And the money helps. Your salary triples after the Taiwan trade. You move from a studio in Queens to a 1-bedroom in Tribble. You start getting recognized at industry events. People know you're on floor 41 now, even if they don't know what floor 41 does. You're someone who matters. By December, you're running point on the energy sector. Oil prices have been volatile all year, spiking on geopolitical fears, crashing on demand concerns. Victoria tells you the firm's clients' pension funds, sovereign wealth funds, the kind of money that moves in 9-figure blocks, are overexposed to energy equities. They need an exit. Not a slow rotation, a fast one. You model a scenario where a major OPEC producer announces an unexpected production increase, flooding the market with supply. Oil prices would crater. Energy stocks would follow. The clients could exit their positions into the panic selling, then re-enter 3 months later at lower prices. Who's the producer, you ask? Victoria doesn't answer directly. Build the trade structure. Assume the announcement comes in 72 hours. You build it. Short positions across the energy sector. Options strategies designed to profit from volatility spikes. Coordinated selling sequences that will trigger stop losses across retail and institutional holders. The structure is brilliant in its brutality. When the selling starts, it will cascade through every energy ETF, every pension fund holding energy majors, every algorithmic trading system programmed to cut losses at certain thresholds. You execute the setup on a Wednesday. Friday morning, Saudi Arabia announces an emergency production increase to stabilize global supply chains. It's framed as a humanitarian gesture to lower fuel costs for developing nations. The announcement is a surprise to every oil analyst, every energy minister, every intelligence service, except Floor 41. Oil drops 19% in 4 hours. Energy stocks collapse. The S&P 500 loses 200 points. Your models predicted every phase of the decline within a margin of 3%. The firm's clients exit their positions. The profit distributed across the network of funds Floor 41 serves is north of $6 billion. You make $2.3 million in performance bonuses that quarter. That night, you're awake at 3 a.m., staring at the ceiling. You've crossed a line you didn't know existed. The Taiwan incident felt ambiguous. Maybe the firm just got lucky with timing, but this was coordinated. The production announcement wasn't random. Somewhere, someone made a decision that aligned with Floor 41's models. You don't know how that happens. You don't know who has that kind of influence, but you know it happened. Victoria never explains. When you ask, she just says, "Our job is to read where the system wants to go and help it get there efficiently." The system wants stability. Sometimes stability requires shocks. You stop asking questions after that. The next 6 months are a blur of interventions. A corporate debt bubble in Japan, a real estate correction in Canada, a currency crisis in Turkey that spreads to emerging markets. Each time, you identify the weakness, model the cascade, execute the trades. The crashes are precise. The recoveries are managed. The profits are extraordinary. You're promoted in June. You're now one of 3 senior strategists on Floor 41. You have your own team 2 junior analysts who do the computational work while you design the scenarios. Your compensation package is now heavily weighted toward carried interest in the firm's proprietary fund. You're not just executing crashes anymore. You're owning a piece of them. Your parents think you're a risk analyst. Your college friends think you work in algorithmic trading. No one knows what you actually do. You've signed NDAs that carry criminal penalties. You've had conversations with lawyers about information compartmentalization. You've been briefed on operational security by people who don't give their names. You rarely leave the office before 9 p.m. You stop dating. You stop seeing most of your friends. The only people you talk to are other traders. And most of those conversations are about positions, models, catalysts. You've started thinking in terms of basis points and volatility indices. You see the world as a series of imbalances waiting to correct. In October, Victoria calls you into her office. There's someone else there, a man in his 60s, gray suit, no introduction. He asks you about your work on the energy sector collapse. Specific questions about timing, execution, how you managed the information flow. You answer carefully. He nods, makes notes, says nothing about who he is or why he's asking. After he leaves, Victoria tells you he's from one of the clients. They're impressed, she says. They want you on a special project. The project is the largest intervention Floor 41 has ever attempted. The target is the U.S. Treasury market. For months, foreign holders of U.S. debt, China, Japan, Saudi Arabia, have been quietly reducing their positions. It's not a crisis yet, but the trajectory is unsustainable. If the selling accelerates, Treasury yields will spike, borrowing costs will explode, the federal deficit will become unmanageable. The clients want a controlled burn, a sharp spike in yields that scares foreign holders into stabilizing their positions, followed by a recovery that restores confidence but resets expectations about U.S. fiscal stability. The target date is early February. The catalytic event will be a worse-than-expected inflation report. The intervention will amplify the market's response, pushing the 10-year Treasury yield from 4.2% to 5.8% in 3 days. Pension funds will panic. Foreign central banks will pause their selling to avoid further losses. The Fed will signal intervention. Markets will stabilize. The whole cycle will take 2 weeks. Your job is to model the cascade and manage the execution. You'll be coordinating with 4 other firms, all connected to the same client network. The positions involved total $94 billion. You spend 7 weeks building the models. You war game every scenario. What if the Fed intervenes early? What if foreign central banks accelerate selling instead of pausing? What if liquidity dries up and the Treasury market freezes? You build contingency structures for each outcome. You test the models against historical crises, 1987, 2008, 2020. You calculate the probability of containment at 87%. Victoria approves the plan on January 15th. The inflation report drops on February 6th. It's bad 0.8% month over month, well above expectations. Treasury yields jump immediately. That's normal. What isn't normal is the selling pressure that follows. Algorithmic systems start dumping long-duration bonds. Foreign holders accelerate their exits. The 10-year yield hits 5.1% by noon. You execute the amplification sequences. Short positions across the Treasury futures market. Coordinated selling to dark pools. Strategic unwinding of carry trades that forces leveraged funds to liquidate. The selling becomes a wave. Yields hit 5.6% by market close. Day 2. The panic spreads. Corporate bonds start selling off. Mortgage rates spike. The stock market drops 4% on fears of a debt crisis. Yields hit 5.9% higher than your model predicted. Day 3. The Fed chair gives an emergency statement. She signals that the Fed is prepared to intervene to stabilize markets. Treasury yields fall to 5.4%. The stock market recovers 2%. Foreign central banks issue statements reaffirming their commitment to U.S. debt. By day 7, yields are back to 4.9%. The crisis is over. The positions are closed. The profit is $11.7 billion across the network. You made it work. You controlled a crisis in the world's largest, most liquid market. You bent the Treasury market to a predetermined outcome. But the containment probability wasn't 100%. It was 87%. For 3 days, you were betting $94 billion that the other 13% wouldn't happen. If the Fed had delayed their statement by 24 hours, if foreign selling had continued, if liquidity had frozen, the Treasury market could have collapsed. Not corrected. Collapsed. And you would have been the one who pushed it over the edge. You don't sleep for 4 days after the positions close. You keep running the alternative scenarios in your head. In one version, yields hit 7%, and the US government loses the ability to borrow at sustainable rates. In another, the Treasury market seizes and the entire global financial system follows. Those scenarios were possible. They were in your models. You saw them. You just bet they wouldn't happen. Victoria tells you not to overthink it. We manage the risk, she says. That's the job. But you can't stop thinking about the 13%, about the fact that you were willing to take that risk with other people's money, other people's retirements, other people's futures. You made $8.4 million in performance fees from the Treasury intervention. That's what 13% uncertainty is worth, apparently. You start noticing things you didn't before. The way Victoria talks about markets, not as systems driven by millions of independent actors, but as machines that can be programmed. The way the clients are never named, never seen, but always present in the background of every decision. The way Floor 41 operates in a space between legal and illegal, never quite crossing lines, but always dancing along them. You think about leaving. You've made enough money to walk away, but where would you go? Back to running back tests at a normal desk? You've seen how the system really works now. You know where the pressure points are, how crashes are made, who profits when the world breaks. You can't unknow that. And if you leave, someone else will take your seat. Someone who might not be as careful with the models. Someone who might not spend 7 weeks wargaming contingencies. At least if you stay, you can manage the risk. At least you can try to keep the crashes controlled. That's what you tell yourself. It's March now. You're preparing for the next intervention, a correction in the commercial real estate market that's been building for months. The models are elegant. The execution will be clean. The profit will be substantial. You're sitting at your terminal on floor 41, looking at charts that represent trillions of dollars in assets, millions of jobs, entire sectors of the economy. Your hands are steady on the keyboard. You know exactly what you're doing. You hit execute. The market starts falling 3 minutes later, precisely as modeled. You watch the cascade begin, the sell orders flowing through the system, the algorithms triggering, the panic spreading in controlled waves. It's beautiful in a way. How predictable it all is when you know where to push. Victoria is watching over your shoulder. She doesn't say anything. She doesn't need to. You become very good at this. Outside the window, the sun is setting over Manhattan. Somewhere down there, people are checking their retirement accounts, watching their savings decline, wondering what went wrong. They'll read explanations tomorrow about market fundamentals and economic cycles. They'll never know about floor 41. They'll never know about you. The position is up $340 million in the first hour. You make an adjustment to the selling algorithm, slightly less aggressive. Niche. The decline stabilize at 7% instead of 9%. Controlled demolition. That's what Victoria called it on your first day. You understand now what she meant. The markets were going to crash anyway. They always do. All you're doing is deciding when and how hard and who gets out first. Your phone buzzes. A message from Victoria. Well done. Debrief at 9 a.m. Next target is healthcare sector. Start modeling tonight. You close the message and turn back to the monitors. The real estate positions are still unwinding. You'll watch them for another 3 hours, making micro adjustments, ensuring the crash stays within parameters. This is your life now. This is who you've become. The strange part is how normal it feels.